After a steep sell-off, CARMAX INC is back on everyone's radar. But that pullback may be an important reset that creates a more attractive risk-reward for long-term oriented investors. CarMax is the largest used car retailer in the US, operating nationwide retail stores and an expanding online marketplace. Its core operations include buying, reconditioning, and selling used vehicles, plus related financing, extended warranties, and service. Revenue drivers are retail and wholesale used car sales, retail financing margins, and increasing digital sales that aim to lower cost per unit and expand geographic reach. The company's strategic focus is scale, inventory turn efficiency, and improving the online to offline customer experience to capture more of a shifting used car market. There are a few constructive headlines recently. Management announced a targeted cost program, $150 million over 18 months, to protect margins and cash flow. A refreshed brand and marketing push. The new positioning aims to boost retail traffic and conversion. And signs of institutional buying, with some large investors reportedly adding or increasing positions. I'll note the reason for the drop once, an earnings miss, and softer volume, price dynamics, then focus on these concrete responses and why they matter. Several factors could turn this into a rebound rather than a prolonged downtrend. First, cost reductions directly protect margins and cash generation while volumes normalize, giving management more optionality. Second, brand and marketing upgrades paired with CarMax's scale and digital capabilities can improve retail conversion and increase higher margin retail mix. Third, used car markets are cyclical. When pricing and volumes normalize, a market leader with operating leverage can recapture share. Fourth, institutional interest can stabilize sentiment and reduce forced selling. Key near-term catalysts to watch are execution of the cost program, follow-through on the brand relaunch, sequential retail sales improvement, and continued institutional support. Over multiple quarters, the recovery case is measured but plausible. CarMax's scale gives advantages on trade-in economics, reconditioning efficiency, and inventory quality. If management delivers the $150 in savings, shows steady retail conversion gains from the marketing push, and stabilizes margins, free cash flow should improve and sentiment can reverse. Institutional purchases and any analyst price target resets reinforce that some longer-term investors view the sell-off as a dislocation, not permanent impairment. That combination, execution on costs, better retail economics, and improved sentiment, is the basis for potential upside. In short, the sell-off was sharp, but management has taken concrete steps. Cost cuts, a marketing refresh, and visible institutional interest that could form the backbone of a recovery if executed. If you're watching for a rebound, track the checklist: cost execution, retail mix, margin stabilization, balance sheet actions, and focus on milestones rather than short-term price moves. If this breakdown was useful, like and subscribe for more catalyst-focused coverage, and leave a comment. Which KMX milestone are you watching first? This content is for informational and educational purposes only and is not financial advice. Do your own research and consult a qualified advisor before making investment decisions.